All right, welcome everybody. My name is Sergio Rebelo, and I'm going to host this for a little bit until Roberto Rigobon comes and shares the session. This is a session on inflation challenges after COVID-19, a very important topic, and we're going to start with the presentation by Juan and Garcia on what can trend inflation tell us about long-term inflation expectations. So, Juan, the floor is yours.
Sharing the screen. Yep, can you see? Yep.
Looks good.
Well, first, thanks to organizers, for allowing us to present this paper. This is joint work, with Aubrey Poon, from the University of Strathclyde. And this is, you must have heard this, a lot these days, but this is the usual disclaimer applies. So this is working for the ECB. The views you are going to hear are exclusively ours and do not necessarily represent the views of the ECB, the Executive Board, and the ECB management. The title of the paper is What Can Trend Inflation Tell Us About Long-Term Inflation Expectations? And we believe that a lot. And hopefully I can convince you. This is the case. Let me give you a brief outline of how I structure the presentation. I will start with the motivation. Then I will focus on the euro area case that in terms of inflation expectations and inflation dynamics is a bit extreme, at least more extreme than the US one. But we also have some international evidence, from the US, Australia, South Korea, and Thailand in the paper. I don't think I will be able to cover them, but if time allows, at least I give you an overview of how these cases differ from the euro area one. And then I will conclude, with the implications, for policy and research. The motivation is relatively simple. It's just the low inflation period. We have experienced, over the last decade, of following the global financial crisis, has triggered some concerns of how persistent it could be and whether inflation dynamics has really changed. So that's one of the issues, we try to address in this paper. The other one is that long-term inflation expectations have become more difficult to interpret in that low inflation period. In particular, the central banks that believe, we have the luxury of having both market-based indicators and survey indicators, and we could easily, contrast them, had some serious problems, over this period in particular, because surveys were broadly unchanged, as I will show, whereas there was very significant declines, in inflation compensation, at least in both sides of the Atlantic. And the motivation for this paper is not just this low inflation period. Of course, this is our main sample, but as the title of the session, says, a good understanding of inflation dynamics and long-term inflation expectations would be crucial, for the optimal monetary policy response to the rebound of inflation we are now experiencing, and how temporary, this could be. So let me illustrate, the case of the euro area. Would you see there, screen? Basically, you have indicators of inflation. In the euro area, the thick black line is headline inflation, the year-on-year on the HSCP rate, and the dashed line is core inflation, excluding energy and processed food prices in the euro area. Before the global financial crisis, it was nicely fluctuating around the 2%. Then it came big fluctuations, triggered by the crisis. But the most important development, for this paper is the significant decline, of inflation experience, since 2013 or so, and that only temporarily has rebounded, to 2%, but has become, persistently below the 2% target, and only very recently, has again reached target. But we see, for how long, this will persist. In terms of core inflation, it's also very clear that it has stabilized at a much lower level. And the idea is to examine, inflation dynamics to see what can explain, these developments in inflation. In addition, I mean, there you have the same inflation. The chart is a bit complex, but you have exactly, the black lines are exactly as you saw before, and they are complemented in this version, I mean, with the two measures of private sector inflation expectations. Basically, you have the dots that are the surveys. I mean, the red dots are for the survey of professional forecasters of the ECB, and the blue dots are for consensus economic forecasts, 6 to 10 years ahead, I mean, the standard for many countries. And the blue line is the benchmark measure of inflation compensation, long-term inflation compensation, the 5-year forward in 5 years, derived from inflation-linked swap rates. That has become, I mean, the main indicator, I mean, for long-term inflation expectations in the euro area using financial indicators. I mean, the most striking feature there is that despite, I mean, these changes in inflation, I mean, surveys have remained broadly unchanged. I mean, there was only a very minimal decline, I mean, already in 2009, but nothing else. And instead, I mean, there has been a very significant change, first in the level of long-term inflation compensation. As you can see, I mean, this is before 2015. It used to be well above the survey measures. I mean, I guess, I mean, everyone knows that inflation compensation is not a direct measure of inflation expectations because it contains, I mean, additional premium, I mean, requested by investors, I mean, to cover, I mean, for the uncertainty regarding future inflation. And before the global financial crisis, I mean, it was normally assumed that the level of inflation expectations embedded in long-term inflation compensation was broadly consistent with that of the surveys. Then the difference between the inflation compensation, the blue line, and the dots was there normally attributed, I mean, to a positive inflation risk premium. I mean, in the second part of the sample, I mean, holding that assumption has been a bit more challenging because since it has declined, long-term inflation compensation has declined so much, this would imply a very persistent and very sizable, of more than 100 basis points, a negative inflation risk premium. Those are the challenges, I mean, we hope to address, I mean, in this paper, explaining, I mean, how this come about. We focus mainly on 3 key questions. I mean, the first one is whether inflation dynamics has indeed changed, and if it has changed, how. For that, I mean, you use an observed components stochastic volatility model to identify which is the permanent component and the transitory components and how they have evolved over time. I mean, this is in line with the existing literature, in fact, very close to the Chang, Clark, and Coop JMCB, I mean, paper. The other 2 questions, I mean, concern, I mean, the behavior of inflation expectations. I mean, the first one regarding surveys is whether they have become too disconnected from actual inflation, I mean, to provide a useful measure. And will provide evidence on the pass-through for changes in inflation and the joint modeling and extension of the UCSV model, I mean, incorporating surveys, I mean, to get additional insights. And the second question is whether inflation compensation has overreacted to low inflation. And this explains, I mean, the declines. As before, I mean, in similar fashion, I mean, to the surveys, I mean, I would provide information on the pass-through, I mean, we can infer from that, and then we can infer from an extension of the UCSV model, I mean, incorporating this inflation compensation to better understand, I mean, their behavior. So let me go first, I mean, to the first question, I mean, regarding inflation dynamics. I mean, the model is fairly standard, as I said, I mean, for this literature. I mean, it decomposes observed inflation into trend inflation or permanent component and a cyclical component or inflation gap. I mean, this is the standard setup in these models. I mean, trend inflation, I mean, follows a random walk, whereas the inflation gap, I mean, follows an AR1 process. I mean, with BT, a persistent parameter that is also allowed to vary over time, and all the time varying parameters, I mean, are allowed to have stochastic volatility just to accommodate potential changes. So let me illustrate, I mean, we'll see what this model offers us. I mean, this is the decomposition of the red dashed line, I mean, headline inflation, as you saw before, and is decomposed into the trend inflation or permanent component, the black line, and the blue bars that are the transitory component. I mean, the main insight here is that in the second part of the sample, there is a very significant decline in the trend inflation, which is mainly explains, why headline inflation, was so low. There is also a slightly stronger, contribution, for transitory components compared to the pre-crisis period, but the bulk of the decline in headline inflation and core inflation is mainly explained by this permanent component, so it has a permanent nature. So the next step is to analyze, how these permanent changes and whether these permanent changes, have been incorporated into surveys, or by considering them, what can we learn about the behavior of these indicators of inflation expectation. First of all, trend inflation is by construction the inflation rate expected to prevail once effects from the transitory shocks die away. So it's a natural benchmark. It's a sort of conditional long-term inflation forecast, to which compare the analysis. And I will move into the incorporating, the information from that trend inflation into the surveys, to see what are the insights, we can obtain. First, we consider pass-through effects, from changes in inflation over the previous 6 months. So then what you see in that graph is the posterior mean of the estimates of the lambda 2 parameter, given the lack of changes. You saw in inflation, not surprisingly, we don't find any significant pass-through from headline inflation, core inflation. And even for trend inflation, the thick line there, as you saw in the previous slides, is the smooth estimate of trend inflation. We also carry out an estimation in real time since 2004, but there's no evidence of any pass-through there. We move to try and analyze, in greater detail, the link between the surveys and trend inflation. Basically, we superimpose, on the same model we had before, the last equations at the bottom, 2 additional equations, one linking the observed surveys to the trend inflation rate by means of a slope coefficient and an intercept, subject to an MA error, purely the residual in this model. Both are allowed, both coefficients, D0T and D1T are allowed to vary over time. So then we can see how this relationship has evolved over time. Looking at this estimation, what we see first, considering, the intercept level, here in the left-hand side, you have the posterior mean of the estimates. This is positive and significantly different from 0. In terms of the Mince-Sarnovich interpretation of this equation, this would mean there is a level bias in the surveys. So surveys are overstating, what would be, the true level or a more reasonable level of inflation expectations. The slope coefficient, we cannot see that this is statistically different from 1, but it's just marginal. It's quite low, barely above 0.9. And on top of this, when we impose, 1 as a coefficient, for trend inflation in the equation for surveys, we see, as you see in the purple line, on the left-hand side chart, we see a decrease in the bias, but it remains positive and significant. So based on this evidence, we conclude that it is true that surveys, may have become a bit too disconnected, for actual inflation developments, at least during this period. Regarding inflation compensation, we proceed in a similar fashion. Incorporating inflation compensation into trend inflation estimation is a novelty of this paper, and we believe, it makes a lot of sense because in essence, the components of interest of inflation compensation are unobserved. We observe, the overall inflation compensation, but what we are interested in from a central bank point of view is what is the level of long-term inflation expectations, the inflation risk premium, and whether it incorporates any other premium. So let me go through the same sort of analysis. I mean, looking at the pass-through equation in similar fashion as explained, I mean, for the surveys, I mean, we find a bit more impact, but varying over time, but not very strong. I mean, for headline inflation and from core inflation. Instead, there is a very strong impact and significant, I mean, in particular, I mean, since 2010 onwards, I mean, from changes in trend inflation into inflation compensation. And this, as before, I mean, the discontinued line, I mean, shows the impact, I mean, for real-time estimates, I mean, rather than the smooth estimates. Let me then illustrate how we propose, I mean, to model further, I mean, the link between inflation-linked swaps and trend inflation in similar fashion as before. I mean, there is a time varying slope coefficient, and the intercept now becomes, I mean, a natural, or has a natural interpretation as the inflation risk premia once the level of inflation expectations is pinned down, and the MA error, I mean, captures all the sort of distortions, I mean, related to trade in the model. For this inflation risk premium, I mean, we model this as before, but we add additional information coming from the balance of risk observed in the inflation options market. In particular, in our benchmark estimation, I mean, we consider the probability of inflation being above 2% versus the probability being below 2%. I mean, around the central bank target. It works well. I mean, Lutz has a paper in which with Simone Manganelli, I mean, his time at the ECB, when he considers, I mean, more the reaction of agents to more extreme risks, I mean, upper risks and lower risks. They are very, in terms of the estimation, I mean, the strikes are not that liquid at certain high horizons, for example, during this period. So that's why we consider, I mean, the baseline probability around, I mean, the target. Let me illustrate, I mean, what you obtain from that. I mean, basically, everything will be based on that additional equation. I mean, the slope coefficient is very similar to 1, even if we restrict the inflation risk premium specification, I mean, not to incorporate, I mean, the balance of risks, you obtain exactly the same, very close to 1, I mean, result. And regarding the estimation of the level of the inflation risk premium per se, I mean, this is, you see, I mean, a decline over certain periods, even negative. I mean, in some instances, but mostly positive and not this hugely negative inflation risk premium that we need to incorporate, I mean, into the analysis if we believe that the level of inflation expectations in the market is exactly the same one as reported by the surveys. In terms of the decomposition of inflation, I mean, this chart, I mean, fully illustrates, I mean, from the line at the top, which is the long-term inflation compensation, I mean, how this could be decomposed into mainly into the level of long-term inflation expectation, the thick black line, I mean, and the level of the premium, I mean, the blue bars at the bottom. I mean, and basically, we conclude from this analysis that the bulk of the decline in the observed long-term inflation compensation comes from a decline in long-term inflation expectations, with some periods, I mean, complemented, I mean, by very low inflation risk premium. And based on this evidence and also the pass-through, I mean, we conclude that there is no fundamental case, I mean, for arguing that inflation has overreacted to the low inflation. They just simply have revised significantly down inflation expectations in line with the evidence. That's the evidence for the euro area. I mean, I don't know if you want me to take any questions. I mean, if you have any so far, or I can provide, I mean, this overview of other cases. Okay, I'll go ahead with this. I mean, in the US, the situation in the US is more benign in the sense that inflation compensation declined, but it has remained, I mean, much closer, I mean, to the 2% level. I mean, surveys also remain, I mean, broadly stable, I mean, over this. Oh, sorry. Sorry, it got stuck. Okay, oh, there we. Okay, sorry about this. So then, I mean, in terms of the pass-through, we also see that there is very little impact from core inflation and headline inflation changes, but also U.S. inflation compensation reacts to trend inflation changes. And the moderate decline in recent years in inflation compensation is explained both by a combination of lower inflation expectations, but they remain very close to the 2% level, and also a decline in inflation risk premia in the second half of the last decade. The case of Australia is of particular interest because it was well known, I mean, inflation targeter that had survey inflation expectations extremely aligned, I mean, to the midpoint of the target, but they have also suffered, I mean, for significant, for very persistent low inflation in recent years. And the difference, I mean, with the euro area, they have the surveys, I mean, very broadly unchanged, but they also have a stable, although marginally below target trend inflation. This explains why they have not hit the target, but they don't have, I mean, any significant deviation of inflation, I mean, outside the band. In terms of the joint modeling, I mean, the slope of the surveys, I mean, is very close to the theoretically consistent one, but they have a slightly positive bias. The case of South Korea is of interest because it's one of the few advanced economies that reacted to the low inflation by lowering the target. I mean, their surveys have been revised downwards significantly. I mean, even before, I mean, the target, the downward revision in the target was implemented. And in fact, I mean, trend inflation, I mean, has been declining, I mean, for long, and has been below the two announced targets for many people. In fact, acting as an attractor, I mean, for the surveys that with a very high slope coefficient, I mean, they tend to approach trend inflation estimates with a lag. The case of Thailand is also of particular interest because it's a large emerging economy that has been or was growing, I mean, very strongly, I mean, with average growth of 4% or so, I mean, in the second half of the last decade, but they suffered by 16 months, I mean, 60 consecutive months of outright deflation, I mean, which was quite unusual, I mean, for an emerging economy. There, they have declining inflation trend, I mean, for long, I mean, below the midpoint of the target, I mean, approaching, I mean, the lower end of the target. And surveys, as in the case for Korea, I mean, has tended to react to these trend dynamics, I mean, moving below the inflation target. In the case, I mean, this is the slope is marginally above 1 as well. I mean, the link to trend inflation. And this leads to this adjustment of surveys, I mean, leads to mostly unbiased, I mean, survey expectations. Let me just conclude, I mean, with the main messages, I mean, we draw, I mean, from this international evidence. I mean, first of all, I mean, we believe that trend inflation modeling would be very useful for understanding long-term inflation expectations, not only in this low inflation period, but over the future. And the results, I mean, point to different expectation formation process in surveys and in inflation markets when the central bank, I mean, can have access, I mean, to these two indicators. For surveys, I mean, we believe, I mean, the evidence we presented, I mean, not only for the euro area, not adjusting, I mean, to trend inflation, but also for countries like South Korea and Thailand, where inflation only adjusts with a lag. I mean, this points to the presence of some informational frictions, not only at the short term, as the literature, I mean, has reported and documented, but also in the long run. And this is where the models of sticky or noise information or rational mutation, as used and Kilian and Golub, I mean, and all the co-authors, I mean, could be very interesting to be applied as well to long-term inflation expectations. Or maybe, given the short sample, I mean, we have available with this low inflation, I mean, maybe it's just simply a matter of slower learning than the markets, I mean, have taken place. I mean, this would be also interesting to exploit or to investigate in the future. And overall, I mean, for policy purposes, I mean, while survey stability may be very reassuring, I mean, for any central bank, I mean, they should be interpreted with caution, and it would be useful, I mean, to supplement this with additional analysis as the one we are proposing, I mean, with trend inflation. Regarding inflation compensation, I mean, we find that expectations in inflation markets, I mean, could be very informative. I mean, in particular, when there are these changes in inflation dynamics, they seem to react, I mean, much quicker than surveys. The problem with inflation compensation is that the interpretation is often clouded by the presence of this inflation risk premium, because policymakers tend to focus on what is the level of inflation expectations mainly. But trend inflation modeling, I mean, can help in this decomposition and the interpretation of inflation compensation. And in particular, we believe our findings, I mean, provide a strong support for the recent term structure literature that have advocated, I mean, by a richer analysis of inflation expectations in term structure models. I mean, in particular, I mean, the introduction of time-varying long-term equilibrium levels, as Bauer and Rudebusch AER, or the more detailed modeling of inflation, taking into account the energy component, the food component, and the core component. I mean, in explaining, I mean, not only the level of inflation expectations, but also the inflation risk premium as a yellow and co-authors, I mean, analysis. That's all I have to say.
Thank you so much, Juan. Angel, thank you so much for this, and thank you, Sergio, for filling it as a chair at the beginning. Thank you so much. Well, it's a great pleasure. A person that I have known for many, many ages, I think. Next paper, Lutz, Kilian, on oil prices, gasoline prices, and inflation expectations. The floor is yours, Lutz.
I think, yeah, okay.
Yep.
Thank you, Roberto. So this is joint work with Xiaoqing Zhou, and the usual disclaimers apply. It is well known that survey data of household inflation expectations may differ substantially from professional inflation forecasts. One possible explanation out there is that household inflation expectations are more responsive to fluctuations in the gasoline price than professional forecasts. And this may be explained by the fact that gasoline prices are more visible to consumers than any other price, and so they might be reacting more to this price than professionals would. This view was articulated in a paper by Koybin and Gorodnichenko in 2015, who concluded that almost all of the short-run volatility of household inflation expectations is explained by changes in the level of the price of oil, and hence in the price of gasoline. Now, you might say, well, why do macroeconomists care about this? Well, that has to do with the expectations augmented Phillips curve. If you take a conventional Phillips curve based on the survey of professional forecaster inflation expectations, you'll find that in the immediate aftermath of the financial crisis in 2009 to 2013, this Phillips curve predicts much less inflation than we actually saw in the data. It can also be shown that if you replace the SPF by household inflation expectations, you get a much higher level of predicted inflation. So the key insight coming from Koybin and Gorodnichenko was to argue that the surge in gasoline prices that started in early 2009 is explaining that shift in household inflation expectations that improves the fit. Now, technically, they didn't quite establish that, but they argued that. And so I'm going to have a closer look at this in this paper. So let's start with where this insight comes from in Koybin and Gorodnichenko's analysis. They focused mainly on the spread between household inflation expectations and the corresponding SPF inflation forecasts. And they observed that if I correlate this spread with the nominal price of oil, I get an impressive correlation of 78%. And if I run a regression of the spread on a constant and the oil price in dollars, I'm going to get a t statistic of 13, really impressive, an R squared of 61%. And it turns out these results are quite robust for different estimation periods. Now, you might wonder, why did they include the SPF in this regression? Because after all, the story they're telling is all about the household inflation expectations. And their answer to this in the paper is to say, well, we know that the SPF expectation isn't responding to the price of oil. So if you see any action here, it must be coming from household inflation expectations. Well, it turns out that isn't quite true. Because when you look at the lower panel, where I now run the same regressions and correlations, simply based on the Michigan household inflation expectations, the correlation drops from 78% to 11%, the t statistic from 13 to 1, and the R squared from 61% to 1%. And what's worse, things are extremely unstable across different estimation periods. And so what does that mean? It means it's actually the SPF forecast that's responding to the oil price, not the household inflation expectation, and it's responding in the wrong direction. So if you want to re-examine this, we really have to get rid of the SPF data and focus on what we're really interested in, namely the household inflation expectations. We are interested in particular in whether the coefficient beta in regression 1 is different from 0, which would indicate that there is some correlation and possibly some causality, although I'm going to stay away from the causality issue for now. So we're going to look at this starting with data in 1990. We also looked at longer samples. That only makes our case stronger. And there's an argument that there might be a structural break in 1990. That's why we start then. What we find in the baseline regression is a correlation of 29%, a t statistic of 1.83, and an R squared of 9%. That's quite different. It's much weaker than the earlier results in the literature. But that's just a baseline. There are a few issues we need to worry about. The first issue is, why is it that we're including the oil price in levels, in dollars in this regression, as opposed to log levels, as most economists normally would do? Well, it's certainly true that the gas price at the gas station is in dollars and cents, but that doesn't necessarily mean that when people change their inflation expectations, that they do that proportionately to the changes in the number of cents. After all, inflation is a percent change in the price level. And if I'm trying to extrapolate from one price to the price level, it's natural to do that in terms of the percent change. Now, we would argue that a consumer would presumably respond more strongly to a 5-cent increase in the gasoline price if you start at $1 compared to a 5-cent increase in the gasoline price if you start at $4. Because in terms of the percent changes, these are quite different changes. And that argues that you really want to work with a log specification for the regressor here. And that's what's shown in this panel. So you see that if you go to logs, the correlation drops from 29 to 20%, the R squared from 9 to 4, and the t statistic to 1.25. That gets us to the second concern, which is, why are we telling a story about the gasoline price, yet running regressions for the oil price? Now, the conventional argument, as explained in Golub is that households pay particular attention to prices they see more often when they form their expectations. And that's a reasonable proposition to start with. But of course, that proposition doesn't apply to the price of crude oil. No consumer has ever bought crude oil. If you stop a random person on the street and ask, what's the current price of crude oil? Well, the person wouldn't know, right? But they would know the gas price. Now, that doesn't necessarily mean that it's wrong to use the oil price as a regressor, because it could be that changes in the oil price are the only reason the gas price changes, and that those changes are being passed on proportionately. Now, if you talk to experts in this area, they might have some concerns about that proposition, but I don't want to get into that. I'm going to ask something much simpler, which is, if this really is a good approximation, then if I redid the regression with a gasoline price, I should get similar results. So let's look at it. The short answer is no, it's not a good approximation. If you look at the last column, you see that we go from a correlation of 29% now down to 15. The R squared is down to 2%, and the t statistic is down to 0.8. So this makes the results much weaker. That gets me to my next concern, And that is that in this literature, it has been standard to evaluate the t-statistics using normal 0-1 critical values. Why is that a problem? Well, the dependent variable, inflation expectations, is plausibly I0, but the right-hand side regressor is not. And so if you regress on the log oil price, that is arguably I1. So if you regress an I0 on an I1 variable, you get an unbalanced regression. And that means that the distribution of the t-statistic may actually be far from normal 0-1, in particular when the dependent variable is serially correlated. That's a well-established result in econometrics. So to deal with this, I'm going to generate finite sample critical values based on the premise that inflation expectations can be approximated by an AR1 model and that the price of oil can be written as a random walk. They're independent, so beta is equal to 0. I can fit this to actual data, and here are the distributions I get. They're shown in blue, and as a benchmark, I also show you the normal 0-1 in red. What you see is that both distributions, blue and red, are centered on 0, but the blue distribution has much fatter tails. And what that means is that the critical values will be much bigger. In particular, instead of using a critical value of 1.645 for a one-sided t-test, we're going to have to use a critical value more like 2.45, which of course affects our ability to reject the null. If I compute the finite sample p-values for the 4 regression specifications I considered, I cannot reject the null at the 10% level in any case, and it becomes particularly difficult to reject the null if I make the regression more realistic along the lines that I just discussed. Now, you might say, as indeed the referee did, that if we think that the log price of oil or log price of gasoline is I1, why don't we just difference that regressor? That's fine. If you do that, you're going to get a modest correlation. And in the regression, you're going to be able to get highly significant rejections, but the R squared is quite small. Interestingly, by the way, the gasoline price works better in that case, as it should. But the question is, first of all, if the R squared is so low, what does that help us? And second, how do we even interpret that regression? It's a correlation, but it doesn't mean there's necessarily a causal effect. And it's not clear how we can use this to talk about the expectations augmented Phillips curve. So the punchline here is that neither static regressions nor reduced form correlations are going to be the right tool to understand this empirical relationship. So what we're going to do instead in the second part of the paper is to introduce a structural VR model that disentangles the relationship between the nominal price of gasoline, headline CPI inflation, and one-year inflation expectations. Like the original analysis, this model is explicitly behavioral. That is, we are trying to measure the response of inflation expectations to gasoline price shocks. But we can also reinterpret that structural VR model from an economic point of view instead of just as a behavioral relationship, and I will do that later. Why do we think a VR is the better tool here? Well, first, it accounts for the endogeneity of the real price of gasoline. Second, it relaxes the dynamic restrictions because in the static model, you insist that the feedback is instantaneous, which seems unlikely. Third, we can actually compute the cumulative effect of gas price shocks, which is going to be essential when we look at the Phillips curve and its fit. And finally, the results we get are extremely robust to changes in specification and identification, and they are robust over time, unlike the static regressions. So here's the baseline model, 3 variables, the log real price of gasoline, headline CPI inflation, and one-year survey inflation expectations. We're going to use 12 lags. There are going to be 3 structural shocks. A positive nominal gasoline price shock is assumed to raise the real price of gasoline on impact. Why? Well, because the CPI is moving more slowly than the nominal price of gas. We also assume that this raises inflation expectations, and that is based on extraneous household level evidence in the literature. We have a second shock, a shock to the core CPI, defined as consumer prices excluding gasoline prices. That also obviously raises consumer price inflation and inflation expectations, again, based on extraneous evidence. And it's going to lower the real price of gasoline on impact, which follows from other extraneous evidence in the literature. And then finally, we introduce an idiosyncratic inflation expectation shock that is designed to capture fears of inflationary pressures, say from quantitative easing or fiscal stimulus, that are not yet reflected in current prices. There is a survey literature that has looked at this and has shown these types of shocks are important. You also see them in the aggregate data, so it's important to include them in our model. If you combine these assumptions, we're going to get a structural impact multiplier matrix that involves zero and sign restrictions, and we can proceed with the standard methods as described in Arias et al. 2018. Our reduced form Minnesota prior is a zero mean for the coefficients. We can show that the prior is uninformative for the vector of impulse responses and is not what is driving our results. Once we have the posterior, we evaluate the joint impulse response distribution under absolute loss, drawing on recent results in work I did with Inoue. Here's the plot of the impulse responses. So what you're looking at is a black line. That is the base estimate of the vector of impulse responses. And red lines, and those red lines are approximating the 68% joint credible set. Let's focus on the second row, which is the response to the nominal gas price shock. What you see is that this causes a persistent increase in the real price of gasoline. It causes a jump in headline inflation, which drops off after 2 months. And it causes an increase in inflation expectations for about 3 months. You can take that model and back out a counterfactual that tells me how inflation expectations would have evolved in the absence of nominal gasoline price shocks. That is shown in red. I'm comparing this to the actual inflation expectations, and the vertical distance between those two lines tells you the cumulative importance of gasoline price shocks. And in the paper, we walk through that graph episode by episode and show that these discrepancies make perfect sense given what we know about history. In this presentation, I'm going to focus on January 2019 to March 2013, which is the aftermath of the financial crisis, which is the episode that Koybin and Gornichenko focus on. It's well known that household inflation expectations increased by 1.5 percentage points on an annualized basis over this period. Our model implies that 1.4 percentage points of this was explained by gasoline price shocks. So that confirms a conjecture in Koybin and Gornichenko. However, that isn't necessarily the case for other episodes. In particular, a variance decompositions based on the estimated model shows that gasoline price shocks account for only 39% of the variation in one-year household inflation expectations. Now, remind yourself that in Koybin and Gornichenko, they argued that nearly 100% are explained by these shocks. We find 39%, that's quite a bit of a difference. Some people we talked to took the opposite point of view and they said, we really believe it should have been zero. Why is it 39%? That's so large. Look, let me give you some intuition. On top here, you see the baseline model. A nominal gasoline price shock is defined as a shock that in the first column has positive effects on all three observables, whereas a core CPI shock has positive effects only on the second and third variable, but a negative effect on the first. If you think about this, you realize that these sign restrictions really are consistent with any domestic aggregate demand shock for the first column and any domestic aggregate supply shock for the second column. To see that, think of extending the model with a measure of economic slack, such as the unemployment rate. Well, in that case, we get different shocks. In particular, the first shock becomes what I would call a gasoline-specific price shock, which really is a supply shock in the gasoline market, which is a column just of pluses. And the last column would become an aggregate demand shock, where we get 3 pluses followed by a minus. So if you look at only the first 3 variables, you realize that the nominal gasoline price shock in the baseline model is actually a linear combination of gasoline supply shocks and aggregate demand shocks in the bigger model. Because we know that gasoline supply shocks are pretty rare, we know that this first shock is going, the nominal gasoline price shock is going to be dominated by aggregate demand shocks, and then it makes perfect sense that we get 39%. And likewise, one can show that the second shock lines up perfectly with an aggregate supply shock. And so that explains a bit better these magnitudes. So, of course, households are unlikely to disentangle demand and supply shocks using economic models. That's not what households do. What they are more likely to do is to extrapolate from the experience of the 70s and 80s, when demand shocks dominated the evolution of the prices of oil and gasoline. In fact, that is consistent with survey evidence that shows that households old enough to have personally experienced the 1970s are responding much more strongly when they change their inflation expectations to a gas price shock than younger people do. But one has to keep in mind that even after the 1980s, that rule of thumb isn't crazy. For example, it works perfectly well for the financial crisis of 2008. And so one would argue that such simple rules of thumbs actually can be optimal in models of rational inattention. We know that consumers use simple rules of thumbs in many other contexts, and so that seems to make sense. Let me talk a bit about sensitivity analysis. One thing we did is to set up an alternative, partially identified structural model with slightly different variables and different identification. And we showed the responses to the nominal gas price shock look exactly like they do in our baseline model. We also showed that we get the same results if you drop the sign restrictions on inflation expectations, if you replace mean by median household expectations. We looked extensively at the temporal stability of the model and showed that even when we make radical changes, things are robust. We showed that including additional measures of economic slack doesn't change the results. And finally, we showed that our results are substantially different from earlier studies on the link from crude oil prices to inflation expectations. As I showed earlier, oil prices and gasoline prices are just not the same thing. It makes a big difference what you use. That gets us back to the inflation, the expectations augmented Phillips curve. So recall that the argument was that replacing the SPF by household expectations gives us a much better fit for inflation. And that, according to Golub and Gordichenko, that's happening because of the surge in gasoline prices starting in early 2009. So the starting point is to fit those Phillips curves to the data, either with SPF data or Michigan Survey of Consumers data, and construct the fitted values. This is what's shown here. That's essentially the same plot I showed you earlier, except now I'm adding one more line, which is called PC counterfactual MSC. That is the Phillips curve evaluated at the data for inflation expectations implied by the structural VR if you turn off the gasoline price shocks. So you want to compare the red dotted line and the black dotted line here. And the first thing you notice casually is that if you start in 2009, those two lines aren't terribly different from one another, right? They're very little different, few differences the first couple of years. And then toward the end, it's actually moving you in the wrong direction because the red dotted line is above the black dotted line, and they're both above the actual inflation rates, which are also already coming down. So what are the key insights from this picture in words? First, for every subperiod and overall, PC MSC fits better than PC SPF. We confirm that result. Second, it is not the case that the PC counterfactual matches PC SPF, which is what Golub and Gordichenko effectively were saying. They were saying the only difference is that households respond to gasoline price shocks. That's not at all what we find. Third, if you break this up into subperiods and you look at 2009 and 2010 first, only 17% of the improved fit we get from using MSC is coming from gasoline price shocks. 83% is not. If you look at the rest, we find actually incorporating gas price shocks makes the fit worse, not better. On average, it makes no difference. Now, the timing and magnitude of the cumulative effects of gasoline price shocks are so delayed and so small that it's really not consistent with any story that tries to attribute the improved fit to gasoline price shocks. There must be a different story. It's not the one that was explained, that was pushed in the Golub and Gordichenko paper. So, conclusions. First, you may have read a lot about the causal link from the level of the price of oil or the price of gasoline to inflation expectations. Whatever you have read, you should disregard because that evidence doesn't hold up to closer scrutiny. We then set up an alternative model to revisit this question. And we showed that gasoline price shocks are one important determinant of short-run inflation expectations, but they're not the most important determinant. Their effect varies over time from episode to episode. They're quite important during 2009 to 2013, but unfortunately, that doesn't help explain the improved fit of the Phillips curve based on household inflation expectations. So that doesn't mean, well, I mean, one point of view here would be to say, well, that goes to show this isn't as important for macroeconomists as we thought. That's not necessarily the right way to think about it. It turns out, actually, this is quite interesting from a central banking point of view, because you see important movements in inflation expectations, even say during the COVID-19 pandemic, that you want to take into account when you think about what inflation expectations are doing. So I think there's still useful information there. It's just not doing what economists used to think. Thank you.
Well, fantastic. Thank you so much, Lutz. Was 1 minute to spare. Fantastic. Thank you. We will come back to questions. Remember, if you have questions, you can post them in the Q&A, and we will have time to come back to this at the end of the session. Sergio, thank you for being here and accepting the invitation. Sergio Rebelo is presenting Epidemics in a Neoclassical and New Keynesian model. You have 25 minutes. Thank you so much for being here. Sorry.
Trying to share just a second.
Yeah.
Give me a second. Apologies, I'm having trouble. Just a second. Hopefully this will work.
We can blame the Fed for this.
I can blame this. Yes, something that monetary policy could fix.
Exactly.
Sorry, I need 1 minute. Maybe people can ask questions while I'm.
It's Lutz. It's very interesting. Have macroeconomists look at the formation of expectations at the household level by looking at some experimental evidence about how they form them? I mean, I know the experimentalists have looked at, a person comes out of the supermarket and they ask them what is the price of the Coke that you purchase, and people have no clue. So the question is there a mapping between that and what you and the theory that the gasoline was such a visible price?
I think it's tricky. I mean, you can do it, of course, but then the question is the sample of the people in your experiment matching the sample that is in the Michigan Survey of Consumers or whatever other survey you're using, right? You always wonder then, is it different because I got a different group of people? And I don't think anybody can do experiments on the scale of the Michigan Survey of Consumers.
No.
So I'm just conjecturing, but I suspect that may be one reason why not that much has been done on that. But I'm not totally on top of the micro literature. So maybe there's some people who have done things like that. I'm just not aware of it.
No, very good. So in emerging markets, we pay a lot of attention to the exchange rate, not necessarily gasoline prices, but that one, the pass-through probably is bigger, so it does make sense that we pay attention. But it would be interesting to see if the same exercises would hold in an emerging market. Well, now that we have solved the problem of technology, and Sergio is back. Thank you so much, Sergio, for being here.
Thank you, Roberto. Thank you for filling in. Apologies for my technical travails. All right, this is going to work with Mathias and Mathias Trabandt. And it's a paper that's a relatively simple motivation. We all know from Macro 101 that the key features of recessions is that output, hours worked, consumption, investment, they all co-move. And another important fact is investment typically falls, but much more than consumption of non-durable goods and services during a recession. I mean, it's also well known that it's relatively hard to generate co-movement in the in these models, but we have a series of business cycle models that kind of embodied our wisdom, our accumulated wisdom on what recessions look like. And so now we have a recession that's associated with an epidemic. And so our idea was to try to put these models that have been used to study business cycles and see what happens if you face them with an epidemic recession. And so just to show you a little bit the data, we of course wrote the model before. This is unusual, but we wrote the model before we saw the data. So, but here's so we're true classical statisticians. We never looked at any data. So you can see here a little bit of a summary. You know, we are all familiar with the green line is all the recessions in the post-war era except the 2008 recession. And I'm sure everybody knows that, you know, output falls for 2 quarters. It falls on average 1.5%. And 1 year later, we recovered. We were back to the output that we had starting out. And then there's growth after that you see over here. Of course, the 2008 recession was a financial recession. It's a little much longer, so it has a different character. And you can see here this epidemic recession we're still living through. It's even more different, you know. So we have a very sharp contraction in output, but then a very quick recovery. This is what's going on with consumption. So again, another lesson we teach students in macro is that consumption of non-durables and services barely fall. So you can see here the green line, basically consumption stops growing, but doesn't really fall. And that's why we use all these preferences that have embodied in them a strong desire for consumption smoothing. I mean, the reason we use those preferences is because they're so consistent with the data. And now that's where the epidemic recession looks completely different, because we see actually consumption falling by more than output. It's incredible. And then this is investment. So investment is well known to fall a lot during recessions. You know, it's much more volatile than output. Perhaps that's what's motivated Keynes to say that investment was driven by animal spirits. And you can see here, once again, a huge fall in investment during the epidemic recession, but then also a very sharp recovery. So the question is, let's take some standard models, some simple models, and let's see what we get to. Are they consistent with these patterns? The last thing before I show you the models is inflation. And I'm showing you here the green line that, of course, inflation tends to be subdued during recessions, but it's particularly subdued here. Of course, some prices went up and they got a lot of attention in the press, but inflation overall in this epidemic recession, I'm showing you the price index. So I'm showing you core PCE, but you can see quite subdued inflation as we got into the recession. So we're going to take some work that we've done to integrate a macro model with the dynamics of epidemics, and we're gonna try to study 3 variants of this model. We're going to start with a neoclassical model, then we're going to have monopolistic competition with flexible prices, and then we're going to have sticky prices, so kind of a simple new Keynesian model. And all of these models actually generate a recession in response to an epidemic. But we'll see the neoclassical model does not generate movement, but the others do. So I'll come to that. So our point of departure is the beautiful work by Kermick and McKendrick, which in 1927 produced perhaps the most influential nonlinear model. It really generates beautiful dynamics that look a lot like the data. And their idea was to classify people into 4 groups. The transitions between these groups are exogenous, and that's what we're going to change. But for now, what are the 4 groups? Susceptible people that have not been exposed to the virus, infected people who contracted the disease. Once we contracted the disease, there's 2 exit doors. And one of them is we recover. And in the standard Kermick and McKendrick model, now we are immune to the virus. But unfortunately, there's another ending to being infected. There's another exit door, which is to die from the infection. And that's unfortunately what we've seen happened to many people in many countries during this event we're still living through. So we're going to use these letters S, I, R, and D to denote the fraction of people that are susceptible. That means not immune, infected, recovered, and then deceased. We're going to start the epidemic with a very small seed, Perhaps the virus came from an animal and was a zoonotic infection that transmitted into the human population. And a very small fraction of people are infected. And everybody else is susceptible to the virus. And that's what made this virus so scary, is that we, the human race, did not have immunity to the virus. So we're going to start with a very, very small seed, very small, few people infected, but all of us are susceptible. And then you're going to see the laws of motion, which is, this is just accounting the number of susceptible people tomorrow is the number of susceptible people today minus the people that got infected. The number of infected tomorrow is the number of infected today, plus the newly infected. And then I mentioned these two exit doors. Some people recover from the epidemic and some people die from the epidemic. So that's the recovery rate and the case fatality rate. These are the recovered, these are the people that had the epi ending. So the recovered tomorrow or the recovered today, plus the newly recovered, the people that were infected and just recovered. And then this is the tragic toll of the epidemic, which unfortunately we still see reported in the front pages of every newspaper. The number of people that will have died until tomorrow is the people that have died until today, plus the people that die in the meantime. So as I was telling you, in this model, the transition between states in the standard SEER model are exogenous. And that's why those models tend to over-predict the number of deaths. And sometimes they even lose their credibility because they come out with these predictions of a very, very large number of deaths because they don't take into account that people change their behavior. So we're going to do something simple here, which is just to bring that to the table. And we're going to try to integrate that epidemic model that has exogenous transitions with the macro model. And so we're going to have a two-way interaction. On one hand, the epidemic is going to cause a recession because people understand that if they consume less of goods that involve social contact and they work less, at least in activities that involve social contact, they reduce their chances of infection. And then this behavior, this self-protection behavior, on the other hand, it influences the dynamics of the epidemic. So it makes the epidemic unfold more slowly than otherwise. So this is going to be our transmission function. It tells us the number of people that are infected. And in this model, people meet in a random way. And these are all the pairwise meetings that can cause an infection. So the ones that are really relevant is, and this is the last term, is the term that Kermit and the only term that Kermit and McKendrick have in their model. So you can see here the total number of people that are susceptible. Remember, those are not immune to the virus. And I is the number of people that are infected. So these people meet randomly, and as susceptible people meet with infected people, then a fraction of those meetings result in susceptible people becoming infected. Right? So this is kind of the Kermit and McKendrick term. What we added are these two other terms, which says, well, it's also the case that people get infected through consumption activity. I go to a theater or a sports event or I go to a shopping center. And people also get infected through labor. You know, I go to my workplace, my normal workplace, and I meet someone who's infected there, and I might get infected. And so I cannot do anything about this last term because it's kind of an exogenous term. I'm riding in the elevator, or I meet someone on my street where I live, and I am susceptible, and I happen to contract the virus. But we can self-protect, and we can do something about this. We can work less particularly in activities that expose us to the virus, and we can consume more particular goods that require social interaction. And so that's kind of what we're going to do. You see very clearly, by the way, in the data, evidence of this self-protection. For example, just a simple piece of evidence. If you look at Open Table, the number of reservations in restaurants fell way in advance of any containment measures because people realized maybe it's not a great idea to go have dinner in a restaurant when there's an epidemic raging. So what you have in an epidemic is something unusual because we have both a demand and a supply shock. So what's the demand shock? Well, I don't want to consume particular things like going to movie theaters or going to sports events or going to restaurants or traveling, because that if I consume those services, I might get infected. So there's a demand shock. So suppose this was the only thing going on. Suppose the only way there was no infection through work. The only economic activity that leads to infections is consumption. Then consumption would drop a lot, but then you'd have a boom in investment because, you know, I still want to work and I want to consume more once the epidemic is done. So I don't. It's a shock to demand. Consumption falls, just like you see in the data, but you have a boom in investment, right? So another effect of the epidemic is suppose that I can get infected by working, but I cannot get infected by consumption. Well, in that case, I don't want to work, and I'm gonna reduce the number of hours that I supply, but I want to smooth consumption because in this example here, I still want to consume. So that in this case, we have a huge fall in investment, right? Because I want to smooth consumption, but I don't want to work during the epidemic because I may get infected. And so the way I smooth consumption is the standard way, and there's a huge fall in investment. So what's interesting is that in the model, you have these two shocks going on at the same time. There's a demand shock, I want to consume less to avoid getting infected, and there's also a supply shock, I want to work less. So the question is which dominate? So we calibrated the neoclassical model with standard parameters. These have come from received wisdom, and you can see them in the paper. But you can see here what's going on is, you have a recession. As I advertised, the epidemic is going to cause a recession. It causes a recession because people want to work less, right? And then people also want to consume less. But now there's a race between these two effects over here. And in this model, you end up having a rise in investment. So you see the model does not generate the movement that I showed you briefly in the beginning of the presentation. So consumption falls, but eventually investment rises. Here at the bottom, you see the dynamics of the epidemic. This, by the way, is the magical point at which the economy reaches herd immunity, because that's when infections fall. Here, there's no vaccines or anything like that. But at this point here, infections start falling. And that's because we drain the susceptibles. In order for infections to keep rising, we need more susceptible people. Once we drain them enough, you can no longer have infections rising. Let me see here what happened. Apologies for this. What is going on? Not doing well technically here today. Okay, here we go. So I just showed you that in the neoclassical model we don't have co-movement. Now let me show you the monopolistic competition model. It's a model that you're all familiar with, and the thing that you see here is that the labor supply effect is going to dominate the shifting consumption demand, and then this model does generate co-movement. And the reason is very simple, is that in a monopolistic competition model, in a simple monopolistic competition model with flexible prices, the wage rate is lower than in the neoclassical model, because that's the way the markup is going to manifest itself, is goods are more expensive and therefore the real wage is lower. Now let's think of the calculation that a worker is going through in this model. I'm trying to figure out, well, should I work? And if I work, I risk being infected, or should I work less? In the neoclassical model, as it turns out, in the steady state, the real wage is pretty high. And so even though I curtail my labor supply, I reduce my labor supply, I don't do it by a whole lot. While here, monopolistic competition means my real wage is actually lower. And because it's lower, when I'm thinking, well, should I, I'm trading off, should I work and risk the chance of being infected, or should I work less? Then here we're going to see that supply effect being bigger. I'm going to show you in the same graph the business cycle model with a new Keynesian feature. All we're going to do is add the Calvo-style sticky prices. And sticky prices, as it turns out, do not do much in this setup. And that's, again, because of reasons that are, if we well understood from the prior literature, which is we know that sticky prices exacerbate demand shocks. So we often think of recessions as a time of low demand. And of course, if prices do not adjust, then we have a bigger fall in output than if prices were flexible. But we also know that sticky prices alleviate supply shocks. And so here we have both the demand and the supply shock, and kind of the effects more or less on net cancel out. So these are the results for both the flexible price version of the model with monopolistic competition and then the new Keynesian model. So let's just go through these. So you can see consumption going down. Going down quite a lot, like the data. So we felt proud that we had calibrated this before we saw any data. You see, it's a kind of a very large recession. You see hours falling, and the falling hours is a bit deeper if you have sticky prices. And then you see investment kind of falling in both cases, and this all adds up to a very large recession. Inflation, of course, moves by more. In particular, the rate of inflation falls by more in the model with flexible prices. So what sticky prices obviously do is they cushion movements in inflation. You can also see that they cushion movements in the nominal interest rate. Here again, you see the dynamics of the epidemic. So you can see kind of, again, this is the point at which we reach herd immunity. And this is the death toll of the epidemic, but you don't see much of a difference. There's some economic differences between the sticky price model and the flexible price model, but there's not much differences in terms of epidemic dynamics. And that's it. We thought it would be quite interesting to take these models that encapsulate a lot of received wisdom in macroeconomics and then run them through an epidemic and see if they can generate co-movement and also see if they can generate dynamics like the data. And we saw that, you know, these models in general work, which I think is a good thing. The neoclassical model, at least in the calibration that we tried, and that could be changed, the real wage is a bit high. So as a result, you know, people are tempted to work even though they risk the probability of infection. So when they do this trade-off in the model, they tend to work a bit. And because they work, but they don't want to consume, then investment rises. But all the other models generate co-movement. I also mentioned that sticky prices generate a slightly larger recession, but they don't really fundamentally alter the predictions of the model, basically because they exacerbated the demand shock, but they alleviate the supply shock. So we're happy to see that kind of this received wisdom, these models that encapsulate received wisdom, if you pair them with a model of epidemics, kind of seem to work quite well.
Thank you so much, Sergio. We will come back with questions. I have several questions, but one, just so you prepare, I would like to understand the sensitivity to the parameters on the choices on the Pi 1 and the Pi 2 that you had there. It will be interesting to know how sensitive the results are to that. And then what other type of data would have given us the idea that indeed we saw a reaction of consumers before COVID lockdowns took place. So I have one on the inflation rate, but it would be very nice to see what else you guys motivated you to do this. Lastly, but not least, so we're very glad to have Jan presenting personal inflation experience and household choices. Thank you, Jan, for being here.
Yes, thank you. I will just quickly share my screen. Can you see everything?
Yeah.
Yeah. Hello, everyone. My name is Jan. I'm a PhD candidate at the University of Zurich. And today I will be talking about personal inflation experiences and household choices. And this is a joint work with Christoph Basten and Marieke Cook, who are also with us today, I think. And I will start by two quick disclaimers. So the first disclaimer is that this project is very preliminary. So this is actually the first time we're presenting it. So any comments and suggestions you might have on the setup are very much welcome. And the second technical comment is that my internet connection is very shaky today. So if I disappear for 10 seconds, don't worry, I will be back. All right, so let's jump right into it. So basically, what we want to look at in this project is we want to look at the connection between experienced inflation at the household level and consumption decisions of households. And what motivates us is the fact that we've witnessed long periods of expansionary monetary policies in developed economies. First, following the financial crisis, and more recently due to COVID-19 crisis. And what some commentators brought up is a concern that this long-term buildup of inflationary pressures might eventually lead to inflation picking up and becoming a major issue for households once again. And at the same time, our understanding of how households react to experience inflation might be incomplete because in the recent decades, most developed countries haven't really seen elevated inflation levels. And back in the times when they did, we didn't have good quality granular data to test households' behaviors with. So our goal here would be to study how households react to personally experienced inflation. And what we mean by personally experienced inflation is really this experiences in daily life, that people go to the shop, observe price changes, and react accordingly. This is a little bit different than you might remember from a famous paper by Ulrike Malmandier and co-authors about long-term lifetime experiences of inflation that also shape people's expectations and behavior. So the key concept in our project is going to be personally experienced inflation. And what we mean by that is that every household in reality experiences a slightly different inflation rate, depending on their consumption baskets, on what prices they are exposed to in their daily lives. And the fact that inflation is heterogeneous for households might have serious consequences for monetary policy too, because if households take decisions based on their personal inflation rate rather than based on headline CPI, that means that effectively the effectiveness of monetary policy depends first on the composition of headline inflation, and second on the distributional characteristics of population, on who gets treated with inflation when. So basically, what we want to do here is we want to use the concept of household level CPI. And this has been long recognized in economic literature, that households experience different inflation rates. So here we follow the definition from two papers by Kaplan et al. And Hobin et al. To define a household level CPI as the weighted average of inflation subindices for specific product categories. So for example, the weight for food would be the total expenditures of households for food divided by total expenditures times inflation for food. And what we will do in our project is we will use microdata from a commercial bank in Estonia, so a country which experienced a period of very high and volatile inflation around the period of financial crisis, to study how households react to this experienced inflation. So before we jump to the technicalities of the project, we wanted to spend a minute talking about why we would expect this contemporaneous experienced inflation to affect consumption decisions of households at all. And we think about two channels. The first one we call the expectations channel. So in economic literature, it's very well established in theory that expectations shape decisions, mainly through intertemporal considerations. And households who expect inflation to go up in the future might bring their consumption forward. And recently, there is a growing literature that goes one step back. That means they look at how personal experiences of people shape their expectations. And one paper that I can especially recommend is a paper by D'Acunto et al. And they have excellent data from scanner level purchases linked with inflation expectations of people. And they study how shopping experiences influence expectations. So usually the conclusion from this literature is that there is a positive relationship between inflation experiences and expectations. So we have this chain of relationships that experienced inflation affects expected inflation, and expected inflation affects consumption decisions. So while most papers look at the link between experiences and expectations, or expectations and consumption, we want to skip the middle level and look at the link between experiences and consumption. So this expectations channel would generally predict that there is a positive relationship between experienced inflation and consumption, in a sense that there is some kind of adaptive expectations formation process, that people extrapolate their experiences into expectations. One can also look at it from the opposite direction too. So for example, one could say that inflation is really a proxy for uncertainty, and then households would possibly prefer to increase their precautionary savings when faced with inflation. So this can really go both ways, depending on how we assume the expectations formation process to look. And the second channel is money illusion channel, and this here we refer mainly to the paper by Deaton from 1977. And here the main idea is that sometimes consumers might misinterpret real and nominal prices. So one example of this would be that imagine that all the prices increased by 5%, then a person goes to the shop and sees that the price of coffee increased by 5%, right? But this person doesn't see all the other prices at the same time. So they might think that the real price of coffee increased compared to other goods, and then forego consumption of coffee, at least for some time. And then the consumption drops. So this channel would generally predict negative relationship between inflation and consumption, also conditional on what we assume the expectations formation process to look like. So in general, what we want to do, we want to have a very simple model where on the left we will have the growth in consumption, and on the right we will have some measure of household level CPI. And this comes with several problems. So first of all, we need to find a setup where we will have enough variation in both directions. That means we will have enough variation across time and across households. Second, we have to address this reverse causality issue between consumption and inflation. And more standard problem in panel models, we have to address the omitted time varying variables that could bias our results. So to address the first issue, we focus on the example of Estonia. So around the time of the financial crisis, Estonia experienced a very high and very volatile inflation that was well above 10% at some point, much higher than in other European countries, except for Latvia. And additionally to that, inflation in Estonia was also very diverse when it comes to sub-indices of inflation, with some categories such as food or housing approaching 20% at some point, and also being very volatile across time. Estonia has also an additional advantage for us of being a very small and very open economy. And there's quite a wide literature showing that in these type of economies, inflation is predominantly driven by external factors, which to some extent alleviates the usual problem with reverse causality. Lastly, we will also have a robustness check exercise where we use recently proposed methodology by Bay from Econometrica 2009. And this is called interactive fixed effect models. So what they do is basically they estimate the unobserved factor. So this is a little bit of an approach of controlling by estimating, and I will talk about this a little bit later in this presentation. And now we also work on some IV estimates, but this is not ready yet, and I will also talk about this a little bit later. So I will first go through what data we use. So we basically have two data sets. The first and the main data set is the account level data set from a major commercial bank in Estonia. So in terms of coverage, this data set is excellent. It covers around 12% of entire population in Estonia between 2005 and 2011. This is a quarterly panel. And we observe outflows and inflows from the accounts. We observe balances. We have information on loans and mortgages. We also have information on investment accounts and term deposits of households. So we can really characterize the entire balance sheets of these households, of those households. And we also see quite a wide set of socioeconomic characteristics of households. The only drawback here, which is quite usual in this type of literature and this type of questions, is that we don't observe perfectly what the money is spent on. So to construct our measure of household level CPI, we use the second dataset, Household Budget Survey, which is the Estonian version of the Household Budget Survey that collects information on household expenditures and a very wide set of characteristics. So what we want to do now is we want to somehow impute the consumption shares from the HBS to the account level data set from the commercial bank. And this comes with a lot of problems, actually, because what we want to do is we would like to assign every individual from the account level data set a vector of weights for different consumption categories. And these weights need to satisfy several restrictions. Well, they need to be non-negative and between 0 and 1, and they need to add up to 1. So we need something more sophisticated than OLS, which usually wouldn't yield results that satisfy those requirements. And this is why we borrow from distributional data analysis literature. And we use something called multinomial fractional logit model. This is basically an estimation method, and that solves a nonlinear model. And as an output, it gives us a vector of weights that satisfy the above conditions. So basically, for the purpose of this presentation, we will treat it a little bit of a black box. When we feed a vector X of characteristics to the model, and in return, we get parameters that characterize the weights. So we will proceed in 4 steps, basically. So in step 1, we will estimate this multinomial fractional logit model of consumption shares using data from Household Budget Survey. And we use a set of time-invariant characteristics of households to obtain the vector of parameters beta. Then we use this vector of parameters beta and the same sets, the same household characteristics that we observe also in the account level data set to calculate the consumption shares in the account level data set. And then for each individual from the account level data set, we are able then to calculate the individually experienced inflation at time t. And this is done quarterly, and weights we like, but by one period, not to have this endogeneity problem with the seasonal shaping weights. And lastly, we will estimate the simplest model with the consumption growth on the left and individual inflation on the right. This is a standard panel model with two-way fixed effects. So we have time fixed effects and household fixed effects, and we also control for income growth and for change in wealth. So this is those are the results of the main model, the simplest one. So what we find basically here is that there is a positive relationship between experienced inflation and consumption. And what these numbers tell us is that 1 percentage point increase in quarterly experienced inflation translates to roughly 5.7% increase in real consumption. And what we also see is that this effect is non-linear. When we add the quadratic term, it's also positive and significant. And what this means, well, the interpretation we give to this finding is that the higher the inflation level is, the more noticeable it is for households and the more they care. There's also a paper by Cavallo et al. 2017 when they look at when they basically say that in high inflationary environment, households start to notice inflation, while if the inflation is low, then nobody really thinks about inflation on a daily basis. But the second question we want to ask is that, so usually in the literature about inflation expectations and consumption, the usual finding is that it's mostly about durable purchases. While here we can't really observe durable purchases per se, we only observe outflows from the account. we can construct a proxy for a durable purchase by defining it as an event when the outflow from the account is especially big. So here we have three different definitions. We define it as being 50% bigger than the usual, 75% bigger, or 100% bigger than the usual. And we run a logit regression with individual experienced inflation as the main independent variable. And here we also find that the probability of these exceptional outflows from the account increases with the experienced inflation. So our main results are that experienced inflation leads to increased real consumption, and that it leads to the higher probability of large purchases. And now we want to ask how households finance this increased consumption. And the first way of doing it is we run a panel logit model with the event being that the household takes out an additional loan. And here our finding is that the probability of an additional consumer loan being taken out increases with experienced inflation. But we don't find it for mortgage loans, which is kind of to be expected, because nobody would probably base a decision to take out a mortgage on prices in the supermarket be slightly bigger. We also look at the stock of financial resources of households and how they change with experienced inflation. So in each of these models, as a dependent variable, we have the growth rate of volumes from the checking account, term deposits, and securities account. And the main finding here is that with increased experienced inflation, the volume of term deposits that these households hold decreases. One more thing that we wanted to show you in this presentation are the results on the interactive fixed effects models. So this is a methodology proposed by in Econometrica in 2009. And basically what it does is that it tries to control for unobserved time varying factors through applying principal component analysis. And what they do is they assume a factor structure of errors and then have a principal component analysis algorithm to construct factors in a sense of a machine learning approach, which is then to control for these time varying variables that we don't see. And here we have the results of this estimation with 1, 2, and 3 factors. And we can see that the results from the interactive fixed effects models are very similar to the results from fixed effect model. And here the interpretation would be that fixed effect models already catch enough variation. There isn't much left for these unobserved factors to influence our results with. So to quickly conclude, our preliminary results show that personally experienced inflation has an effect beyond headline inflation on consumption, because the effect of headline inflation is absorbed by time fixed effects. And this experienced inflation has a positive impact on consumption, which is consistent with the expectations channel that we discussed earlier. And our results also suggest that this increased consumption is financed by a combination of borrowing and drawing on savings. So our results are generally consistent with intertemporal substitution and experienced inflation affecting expectations. And what we want to work in the future is the IV estimates, where we want to look at several indices, for example, the Global Agricultural Index, and we want to try to try a little bit to go into the direction of Bartik instruments, but this is still to be done. So we want to address this issue of reverse causality a little bit more in a more detailed way. So this is everything I had for today. So thank you very much for listening.
Well, Jan, let me be the first one to congratulate you. If this was the first presentation, you did a really fantastic job. So congratulations. It's very interesting. In fact, let me start with you now that I have you here. Did you by any chance try to keep the weights of the personal inflation to be constant and just measuring that at the beginning of the sample and then keep them constant to see how sensible your results were to construct this differently? Again, lagging the variable only once might not be sufficient if the change in consumption is correlated through the quarters, so or if there's some form of seasonality. So have you tried just to keep them constant?
Mm-hmm. We can try it. I think we tried it at some point, and as far as I remember, it didn't make much difference, but I don't want to make any strong statements here. What we also did, we ran several robustness checks with how we construct these weights. So we have a set of explanatory variables that we use in the model, and we also varied them a little bit. So this is it's generally quite consistent.
Very nice. Sergio, do you have a chance to think about what I asked? Jan, if you want, can you?
Thank you. You asked me about the coefficients on the transmission function, because the model depends on the probability of being infected through consumption and labor. And there, we relied on the epidemiology literature. The epidemiology models typically use the same parameters for all respiratory virus, and so that's kind of what we used. And the other question that you asked me was whether there was evidence of this kind of self-protection, that people kind of try to self-protect from being infected. And I would say the best evidence for that comes from consumption. We also see people kind of not showing up as much for work and much more absenteeism during the epidemic. But where you see it very clearly is if you look at data on TSA, on number of flights. I mentioned open table, restaurant reservations, hotel occupancy. All of those variables, they fall way in advance of containment measures being introduced. And on top of that, after containment measures were discontinued, those numbers stayed low. So actually, for example, of course, restaurant reservations, they dropped by 100% at some point because you couldn't go to a restaurant. But once those restrictions were lifted, they kind of took quite a while to recover, and that recovery mimicked the evolution of the epidemic. So I think we have pretty good evidence on that.
Oh, very nice. Very nice. I wanted to ask Juan Angel a question about the survey. He had at the end a statement that if the surveys are too flat, that you should not necessarily trust them that much. So what could be the error that we're making on the survey that is leading you to that? I'm a statistician at heart, so I take offense of that.
Well, the problem we try to analyze in this paper is that if there is a change that there is persistent in nature and is going to last, low inflation in the euro area has lasted, basically since 2014. If this is not incorporated into the surveys, then they become a bit weird. Because that's the problem. Otherwise, what's the point of collecting or running a survey in which people is going to report 2% all the time, no matter what happens? So that's the problem. My first assignment at the ECB was being in charge of the ECB survey of professional forecasters. So that's the point. I'm sympathetic to the tool, but the policy message, I mean, sometimes is very difficult to understand. And there is evidence even for the Philadelphia Fed. I mean, some people from the Cleveland Fed have done some work and saying that this apparent stability of the mean or the median, I mean, really conceals a lot of heterogeneity in the expectations. And this is one of the explanations, I mean, we discuss in the paper, that it could be that this is too much emphasis is put on this median or this mean over time, and not much information is provided about how the individual or the distribution of these point estimates, I mean, evolves over time. I mean, the information is there. I mean, that's why I don't want to be negative on the surveys. As I told you, I mean, that was my first assignment, I mean, at the ECB. So I'm personally linked to the ECB survey professional forecasters forever. But that's the problem. I mean, it's true that for the policymakers, and in particular, I mean, now I move, and my main task was to analyze the inflation compensation. And this discrepancy, I mean, it was quite difficult really to explain to the policymakers. And also the other international evidence, I mean, also points at, I mean, the experience of on Thailand, for example. I mean, I was part of the Thailand team of the IMF. And basically that was the problem. I mean, they were in outright deflation for 16 months in a row. And they were claiming, no, but the surveys are okay. Yes, but reality, I mean, points otherwise. So that's the problem. That's what we try to do in this paper.
Very nice. Very nice. Lutz, you presented amazingly convincing story about it. So I thought it was very convincing. Now, one thing that it was very interesting to me is that now I think that you just transfer the puzzle from one place to the other. So like, why the difference between these two inflation expectations is so incredibly correlated with oil? So you feel that it's all because the actual forecasters are correlated with the oil and the other one is not? Because the sign seems to be weird. You presented that.
We're looking at a pretty short time period. Yeah, I mean, it could be that it's just something else going on in the data that it's picking up that's not about oil. When you look at the survey professional forecasters, that would be our first hunch. I haven't looked at this carefully. In some sense, I moved away from the SPF. I mean, I'm not trying to explain what the SPF is doing. That might be a separate question. I'm focusing on what the household survey is doing. And there the answer is, well, they're not really responding much. I mean, there's some response, but it's not as big as people used to think. But you're right. I mean, there might be another paper to be written to see what's going on with the SPF.
Not only that, is the difference, that the difference is so correlated with oil. That means that somebody...
But that's all coming from the SPF.
Yeah, right? Yeah, I know.
The coefficient on the household expectations is basically 0. And you get a strong negative coefficient on the SPF. And if you do household with a coefficient of 0 minus high coefficient times SPF, the minus becomes plus. And that's where this comes from. So we have an example of that in the paper where we spell this out more clearly.
And the professionals have a negative coefficient on gasoline.
Yeah, so it's not a story that, oh, the SPF moves first in that direction or something like that. No, it's just the wrong coefficient. Now, why? I don't know, right?
So the professional forecasters seem to be not very professional, I guess.
Or it's just some spurious correlation you pick up that might go away if you took a longer evaluation period or something like that.
No, yeah, I think that maybe the answer is there, is that this is a very weird sample. So maybe,
right.
Or again, maybe it's actually Juan Angel's point, is that the policy message is so credible and strong that then professional forecasters are driven away from whatever happens to oil prices. They believe too much the central bank?
Yeah, no, I mean, it's an interesting question. I hadn't thought much about that. But I guess maybe I should look more deeply into what these guys are doing.
No, I just thought it was particularly interesting, and that it has the wrong sign. And that was the other one. So like, you know,
right.
It has the wrong sign. So I was very surprised.
I mean, when I started this project, I was really puzzled why they put the SPF in there in the first place. Because the story you're telling is all about household expectations responding and households thinking this and that. And then what the hell? Why are the professional forecasters suddenly in there?
But you know, I didn't find it that bad, because you see, my view would have been, let me tell you, my view would have been that the professional forecaster has a weight of 6% to say something, and then the household has a bigger response. So they said, let me just compute the difference of the two input responses. So when I saw it the first time, I said, well, it doesn't look that bad. It's almost like controlling for the typical pass-through of oil into the forecasters.
But that assumes that they're both of the same sign.
Yeah, that's the point.
Right? And the other thing is, of course, it's still not right, I think, if you're trying to make a case for how household inflation expectations respond, because it doesn't matter whether they're responding because the SPF responds or they're responding on their own. It's the total effect you need. And by controlling for the SPF, so to speak, you're getting rid of that, and you're not computing the total effect.
No, I understand the point. So that's very nice. Very nice. Any comments you want to say about the paper? Yes.
Yeah, so I have some comments for Sergio in particular. So I like the paper. So here are a few thoughts. One thing that one might want to incorporate in the model, and I'm not sure how important it would be, is expenditure switching. It's not just that people cut expenditures, it's that instead of going to restaurants, you order takeout, right? And so that may not be important enough at the level of abstraction that you are working with right now, but if you want to make this into a policy tool at the end of the day, that might be something to think about. Here's something that I think is much more important, and that is to allow for the possibility of reinfection. In other words, immunity wears off. I think that would be a big step forward in making this model relevant for what people are thinking about right now, right? Where are we going to go? We had this report out of Israel that maybe for Moderna and Pfizer, we're starting to see lower and lower rates. They're far from the original numbers. And so if you're thinking, where's the economy going to be over the next year, next 2 years, that would seem to be first order. And so I would encourage you to do that. And one reaction I had, you said, well, in the model, people don't want to work. In the model, that makes sense. But here are some caveats. One is people, white-collar people like me, actually kept working throughout all of this. And that may not be hard to incorporate, because all you need is the fraction of people, of workers, who can actually work from home. And you simply then remove that from the dip you had in N, and that should be easy to incorporate. The other part was that up to a point, there is evidence that this matters, but there's also missing something. Because the people who used to work for a restaurant are being told not to show up for work because there is no work, right? They are not the ones who say we don't want to work. In fact, lots of lower level blue collar jobs were of that type, where people wanted to work, but they couldn't work. And that's something the model is missing, and maybe worth thinking about whether there's a way of incorporating that. And the last thing would be
let me build on that. I was thinking that maybe having a subsistence consumption would be a way to deal with that. That I might not want to work because I've been infected, but my income level is so low, my productivity is so low that I really.
For example, that's almost like in the development literature, right?
Yeah, exactly.
Yeah.
I have a consumption.
So the last point was, it might be interesting in the context of your model to look at the effects of benefits. Benefits of various forms, unemployment benefits and additional payments, and what that will do in the context of the model to the response. Now, maybe that's too much for one paper, right? But these are some directions.
I think now these are all fantastic suggestions, both yours and Roberto's. The good news is we worked on all of them. So we do have versions of the model that incorporate absolutely everything that you suggested. So I guess that means we are more forward-looking than professional forecasters. So on expenditure switching, to have some sectors that are more contagious than others, on having some professions that are more or less contagious than others. So we wrote a paper on testing and quarantining where we look at the possibility of reinfection. And what that does, it creates these echoes of the initial infection, because you are refeeding the pool of susceptible. So we studied that. We also we looked at subsistence consumption, because it's very tough to. One of the things you look at the data, whereas this data that has been produced by Raj Cherry, is that you see that the employment of low-income people dropped the most, but their consumption dropped the least, and so the subsistence level really helps with that. So we've been on again, I'm not saying that we resolved satisfactorily all of the issues that you raised, but we worked actually on all of them. But not in this paper. We're trying to do something a bit simpler. Just take the models as they are and see sort of some pretty plain vanilla versions and see if they generate co-movement. But thanks, these are great suggestions.
One thing that we did, I wrote a paper with engineers thinking about networks, and then the family composition.
That's right.
Was a crucial aspect. So when we calibrated family composition to be very intergenerational, which is typically what happens in Europe or typically happens in emerging markets, then even the lockdown is severely ineffective, because then you infect different generations and people have very different networks. So that implies that the lockdown is less effective, because there are other forms of contagion that are just due by the family composition.
Yeah, that is right. It can definitely be important in many contexts, because these models assume random meeting, but we don't really meet randomly, right? We meet with our families every day.
Well, although our network is random, so.
Yeah, and so to come back to Roberto, what you said earlier about experiments versus surveys, I think ironically this might work better in a country like Argentina, because in Argentina every cab driver is a hobby economist. People are really well informed, and so you may not have to worry as much about the heterogeneity that you would encounter in the US, where half of the population isn't paying attention to anything, right? And so in that sense, an experiment might be more informative about what you would see in a survey in Argentina than in the US.
Yeah, well, and again, in Argentina, the cab driver will tell you what is the fare and the exchange rate at the same time. So, in real time, talking about real-time finance.
Because it matters, right? So that's where maybe, you spend your attention when it matters, and when it doesn't matter, you just say 2%.
Exactly.
Right.
Good. Well, we have not received any question from the audience, but I think this has been an amazingly interesting panel. Any last comment from what you have learned here that you want to share with all of us, and then we close it down. We can use the 5 minutes for a coffee break.
It's true. No, thank you, Roberto, for asking such great questions and being such a gracious host, and thanks for everybody for I learned a lot from hearing your talks.
Thank you.
And again, congratulations, Jan. You did a very, very good job for being your
Thank you very much.
Very good job. Very good job. Well, thank you, everybody. One of the things that I learned from COVID is that, yes, we all people can work from home. That's one part that I learned. And the second one is that there's absolutely no substitute for human contact. So I really hope that next time when this happens, we can see each other and grab that coffee and tea. Thank you, everybody, for your time being here. I hope our paths cross again, but physically that they cross again. Forget about this crap of Zoom. Okay, I'm tired of Zoom.
Second that.
All right, thank you, everybody.
Thank you.
Thank you very much.
Bye.
Thank you.